Hello, everybody. This is Alan Elman, the Blue Collar Investor, and welcome to this sample trade video titled A Real Life Example with Agnico Eagle Mines Limited, a security listed on the Nasdaq exchange under the ticker AEM. Now, for the last 3 months, the first 3 months of 2025, leading into the fourth month as well, the market has been declining mainly based on concerns over proposed tariffs and trade wars. So I've been crafting my covered call writing and cash secured put trades in a defensive manner, which means I'm creating more protection to the downside and accepting lower initial time value returns. Now I say lower, but yet still significant, as you will see with this particular sample trade video. Now, this is a little bit unusual, this particular trade, because it's only a 4-day trade starting on April 14th, 2025, a Monday, and ending on Thursday, April 17th, 2025. And that's because April 18th is Good Friday and stock market is closed. So this is not a full 5-day weekly trade. It's a 4-day trade. Can we generate significant returns with a defensive cash secured put trade? Well, let's take a look. First off, let's talk about why I selected AEM. This is a little snippet of our 9-page premium member stock report, which we publish for our premium members every weekend. Now, you'll see that I highlighted in pink for you the pink row, AEM, which was rated number 7 on the IBD 50, meaning that it's an elite performer from both fundamental and technical perspectives. Now, AEM is in the industry, the mining industry segment, currently ranked A, and was ranked A as well last week. So those are two bullish signals as well. Now, you'll see here the mean analyst rating, or MAR, is 1.56, which is outstanding. 1 is the best and 5 is the worst. So 1.56, outstanding. Also, the on-balance volume is a bullish signal. You see that up arrow. That means more cash is coming into the stock on up days than on down days. Once again, another bullish signal. Yes, there is a dividend distribution of 1.4% annualized, and the X date is 2/28. Not really a factor with this particular trade. Now, you'll notice here that the at-the-money implied volatility is 64%. That's pretty robust. Okay, it's more than double that of the S&P 500 currently. That means that we could take a defensive posture, go a deep, deep, deep out of the money put strike, and still generate significant initial and annualized returns, as you will see. The earnings date is 4/24 outside the 4/17 contract expiration, so it's a non-factor. All right, let's have a look now at the initial calculations. You could see that on 4/14, AEM was trading at 117.06. I used the deep out of the money 110 strike, which generated a premium of 30 cents for 10 contracts. Okay, 1,000 underlying shares. Now, the spreadsheet, the trade management calculator, tells us that this is a 4-day trade. And if you look in the brown cells here, the time value returns, initial time value returns, 0.27%, 24.95% annualized. Now, is that earth-shattering? No. But what if our local bank put out a CD for 20%? Would we not have lines around the block about 10 times to get that CD? So it is significant. Now, you'll notice here the break-even price point is $109.70 at a time when AEM was trading at 117.06. So if, in fact, the shares drop from 117.06 to below the 110 strike, and we take no action to buy back the option, well, then we will purchase AEM at 109.70, a discount of 6.29% from when the trade was first executed, and AEM was at 117.06. Now you're looking at a screenshot of the broker confirmation of the trade. So 10 contracts at 30 cents produce $300, less $665 in commissions. So $293.35 was in my cash account once that trade was executed. So what happened? Well, after expiration on April 17th, Thursday, I'm making this video the next day, Friday morning, AEM closed at 121.53, actually up $4.47 from when the trade was first executed, and AEM was at 117.06. But watch this. It was also $11.53 above the out of the money put strike, 110. Look at all the room we had to work with to realize that trade. And even better, $12.08 above the break-even price point of 109.45. So even if AEM had dropped down on Wednesday or Thursday, a couple of dollars each day, we still would have had a winning trade. And that is the advantage of taking a defensive posture in a bear or volatile market. We could still make money. Yes, we can, even with a 4-day defensive trade. And the good thing about these strategies is we could craft these trades based on what's happening in the market today. And that may change week to week or month to month, but we have to evaluate what's going on and say, I want to be more aggressive or I want to be more defensive. And then we will know how to craft our trades from there. But if we're seeking greater protection to the downside, no doubt about this, there will be some sacrifice regarding the initial time value percent return. That's the trade-off. So folks, I hope you enjoyed this sample trade video. I'll keep on producing them. And by the way, even if a trade happens to turn out to be a losing trade, you'll see those as well. It's just that lately I've been so careful that almost all of the trades that I've executed have been winning ones despite the volatility in the current market. So thanks for listening, everybody. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.